Are you a Web3 founder, an investor in a Web3 company, or an early employee that's receiving restricted token awards? Then this video is for you. There's some very important tax planning considerations when you're receiving these token awards. And that's what I want to go over in this video today. What are some of those tax implications, and what can you do to make sure you optimize your tax position when you're receiving these token awards? So let's get right into it. To start off with, there's two main types of token compensation that I want to discuss today. The first are restricted token units, and the second are restricted token awards. They're both very similar in the sense that they're providing funds and compensation to founders, investors, or employees that they'll be able to have dominion and control over at a future date. But the mechanics of both somewhat differ. So when we're dealing with restricted token units, it's basically a promise to pay crypto at a future date pending certain critical conditions that are placed within the token awards, usually some form of tenure at the company. Restricted token awards are when employees actually get crypto granted to them up front, but the token units are not freely tradable for the employees at the time they receive them. They're locked up for a period where they have to vest before they're actually able to freely sell these tokens and receive the value for them. So it's a very subtle difference between the two, but it's very important because when we're dealing with restricted token units, the tax planning opportunities are somewhat decreased, but there's a lot more simplicity when we're receiving those. When we're receiving restricted token awards, there are more tax planning opportunities, but also as a result, the tax complexity overall somewhat increases. So, one of the important considerations when you're receiving these rewards is, should you make an 83B election? So what an 83B election is an election that you make when you receive this property that allows you to treat the property as taxable income at the time when you receive it. So going back to the definition between restricted token units and restricted token awards, the restricted token units 83Bs usually aren't going to apply to, because you're not actually receiving the units up front, you're receiving them at a later date. When you get restricted token awards though, you'll be receiving these crypto units and then they will be vested at a future date. So usually for restricted token awards, there is the opportunity for an 83B election. And what this effectively does is, when you receive the token awards before they're vested, at the time when they're granted and you receive them, you can elect to treat the value of them as income up front. And this is a benefit because usually you're going to be receiving these at a low valuation. And, if you're anticipating that the token is going to perform well and the company is going to perform well and it's going to be increasing and appreciating in value as you near the time of vesting, this can be advantageous because you'll take the income tax hit now at the lower valuation, and then in the future, after this is appreciated and it's vested, you'll pay capital gains on the difference when you sell it. Contrast this with if you don't make an 83B election. Then in this case, if you're receiving restricted token awards, you're going to be treating income at the time of vesting. So if you're anticipating that from when you receive the grant to the time of vesting that there's going to be significant appreciation, the 83B election can be a very powerful tax planning strategy. And I've seen this save founders and investors and early employees millions of dollars by being proactive and making these elections. But it's very important to understand that, number one, if you do make this election, you're going to have the funds available to cover the tax liability. And even though, when you make the 83B election, generally it's going to be at a lower valuation, it can still be substantial depending on the valuation of that token. So you're going to have to be able to cover that tax liability. And usually you're not going to be able to use the restricted token awards to cover them because they're still not vested. So you're going to have to come out of pocket to cover these taxes. But the tax benefit can be huge. If you have a token that's valued at 1 cent and it appreciates to 10 cents, you'd much rather be paying ordinary income at the value of 1 cent versus the value of it at 10 cents. So, the other catch with the 83B election is that if you do make the election and then when the token vests, it becomes valueless, you're not able to get a refund on the original taxes you paid. So, there is some risks with the 83B election because you are paying the tax up front. You are sort of making a bet that this token is going to appreciate in the future. But if you do believe that it is, there's going to be a powerful tax benefit that you receive on the timing difference of when you pay this income. So if you are considering making an 83B election, and if you've received token compensation, this is something that you should be sitting down and discussing with the CPA, because it's very important that you critically think about this decision and that you make the right decision so you can optimize yourself from a tax perspective. Additionally, it's very important that based off of how you make these tax elections and the approach that you take, that these transactions are accounted for appropriately at the personal level for whoever is receiving the tokens, and also at the company level who are going to be making these token awards. So our firm at Camuso CPA can assist you with this on both sides. If you're an individual that are receiving restricted token awards and you'd like us to analyze your tax position and discuss 83B elections and other related tax planning opportunities, we'd be happy to discuss that. And similarly, if you're a company that are making these awards to your employees and to your investors, and you need to understand the tax implications of this and the accounting requirements related to this, and maybe even assist some of your employees in planning for it, we can also assist you with this as well. So contact me and my team at CamusoCPA.com, and I'd be happy to discuss this in detail with you.